I'm Chris Mayer. I wanted to open the next panel. Before doing so, I am also the co-director of the Richard Paul Richman Center for Business Law and Public Policy, and I wanted to provide a couple of thanks to people who have been helped put this together. First, a big thanks to Charlie and Ira for their work in both conceiving of this conference, putting together a set of meetings, and really getting what I thought has been an enormously great group of panelists together. So I wanted to give them a big round of applause. Thank you. As well as Weil Gotschel for their generosity in hosting this event. As all of you probably know, particularly in the academic side, you can't do this without really good support and help from people in industry to do this. And this is sort of the first major conference that the Richman Center has put together. I think as Ira did, I wanted to acknowledge Richard Richman, who's here today, who's been a really big help in sort of envisioning and trying to put a tangible put together kind of a tangible infrastructure that we can really bring together people from the business and law communities to talk about important public policy issues. I think this is a starting point for some of the other things that the center is going to be doing relating to financial regulation and governance, but there are other areas. We are running a conference next week, co-sponsored with Zillow and the Public Policy, Progressive Policy Institute on housing and public and private market solutions to the housing crisis, and there will be a series of other events that the Richman Center is going to put forward over time in these general areas. So I think we're all very excited with where the center's headed. And finally, I wanted to thank the staff who worked on this, particularly Kathleen and Josh, for all of their tireless work in getting this event. They're sitting out there watching quietly. So now onto the panel. I was in hearing the previous panel's sort of conversation. I, as somebody who once worked for the Fed, I felt a little bit of sympathy, although I certainly has never been a bank examiner, for the person whose job it is to tell a willing lender and a willing borrower that they're not supposed to complete a transaction. I think that's a really, really hard job to assign somebody, whether they're a politician, a regulator, or anybody else. It does seem like a large order to say to a group of sort of regulators, here's your job is to fix and to make sure that all of these, well-compensated, smart people who have at their disposal large staffs and large resources to step in and tell them that we are now going to come in and fix and sort of tell you what does or doesn't make business sense. So I think in our current panel, we're going to talk to three experts from the academic area who will really kind of provide some ideas about how to address, with specific public policy suggestions, how to address some of the problems that have come up. I would say that I was particularly, some of Mark's comments about where people come from, I would sort of put one other note on the table, which is a lot of the conversation up until now has really been about the banking system, and we're going to hear certainly more about too big to fail, but I would put in the pitch for the securitization and housing finance system, something I know some have done a lot of work on. If you think about the crisis, I was in some sense, as somebody who studied securitization, amazed that it took until September of 2008 for the financial system to collapse. I was on leave from Columbia working at the Federal Reserve Board, a position that I lined up kind of at the last minute in May of 2007, when it became clear that things were really looking into trouble. And while I was sitting at the household finance section of the Federal Reserve Board in DC, In the third quarter of 2007, we went from a securitization system that was funding annually about $1.5 trillion of credit. That's trillion per year of credit. That disappeared over 2 quarters, in the third and fourth quarter of 2007. You may remember that Congress, in order for people to enroll in college in September of 2007, had to backstop the student loans in the country in the summer and fall of 2007, and the entire mortgage finance system had already collapsed by that point, and spreads on Fannie Mae securities were already, on mortgages, were already going to 300 basis points over a 10-year treasury by the beginning of the middle of 2008. So in some sense, you could actually argue that if you looked at the shadow banking system, it had already collapsed, and it was pretty amazing that it took as long as it did to really work its way into the real economy. So the experts on this panel are going to tell us how to fix the problem. At the end of this session, I know we'll pretty much know what we need to do, and it'll be nice to hear the rest of the comments at the end of the day. But I know we're pretty much going to have resolved it at this point. So without further ado, I'm going to start with Charlie Calomiris, who's the Henry Kaufman Professor at Columbia Business School. All 3 of the panelists have long and incredibly distinguished bios, which you can read about in our little book in addition to taking notes. So Charlie, you're up first.
Thanks very much, Chris. And I can't help but recognize Henry Kaufman, my namesake, who is, or I guess I'm his namesake, who happens to be with us here today, and we'll be hearing from him a little bit later. Of course, Chris was joking when he said that we're going to come up with all the solutions. The first panel laid out a very ambitious sort of list of problems that we would be ambitious if we tried to solve them all. I'm going in a very different direction. One small idea, which I argue, while not perfect, doing it would make things better than not doing it. And that is, therefore, it's a real change in tone from the first panel. This panel is, I think, going to be getting down in the weeds a little bit more, and I know I certainly am. And as you can see, it's a paper that's co-authored with Dick Herring, so he gets the distinction of being the only person today who's actually authored 2 of the presentations. Okay, so what is the problem to which this paper is the answer? Protected banks don't voluntarily target sufficiently low default risk. When problems arise, too big to fail bailouts can occur. This is not a hypothetical problem. This is not just a U.S. problem, and it's not just a problem about the last crisis. I'm not going to talk about all of the evidence for this problem. Maybe we'll hear more about it from some of the other panelists later. But that's the question, that's the problem I'm trying to resolve. The solution is that we have to have prudential regulation that specifies and enforces requirements that credibly limit bank default risk. That is the central purpose of prudential regulation. We wouldn't have to limit bank default risk if banks voluntarily set the default risk at the level that we wanted. So that's what prudential regulation is supposed to do. That means budgeting capital relative to risk at the beginning on a forward-looking basis, but it doesn't just mean that. It also means that you have to recognize losses when they occur and make capital increases replace lost capital. And I want to emphasize, this may sound very trivial, but this is it, right? This is the whole thing. You have to be able to budget capital in advance on the basis of a forward-looking conception of risk, and then recognize loss and promptly replace lost capital. Easy to say, hard to do, because, of course, the problem is, as we heard a lot about from Harvey Miller, the will to regulate. And that's one of the phrases that I think will echo for the whole day today, and it certainly echoes in my presentation. So loss recognition, of course, from a prudential regulatory standpoint, is a matter of regulatory accounting. It's a matter of bookkeeping. But the important thing is, from an incentive standpoint, neither banks nor regulators like to recognize losses in a timely way. Banks like to evergreen losses, and regulators like to forbear. And forbearance and evergreening, when I teach my students, I say, whenever you hear a 3-syllable word in finance, it's synonymous with lying. So that's pretty much, this is a good example of that. And we know all about the incentives. Of course, banks would like to kick the can down the road rather than raise capital in the wake of losses, hope that they're going to get some earnings, wait for better market times. And regulators, of course, also face political pressures to go easy on banks. There's a huge amount of evidence for this, again, across many countries and many episodes. It's not just the subprime crisis in the US. But let me give you some concrete examples of these two different problems. I want to emphasize there are two different problems. One has to do with budgeting capital in advance commensurate with risk, and the other has to do with timely recognition and replacement of lost capital. So let's start with inadequate capital budgeting on a forward-looking basis. So Citibank, if you look at April 2006, the market value of equity divided by the market value of equity plus the face value of debt for Citibank was 13%. For Goldman Sachs, it was 8%. But Citibank was the one that failed, became insolvent, not Goldman. So the obvious point is that Citibank might have appeared to be better in terms of its capital strength, but relative to risk, it was actually worse. So our risk-based capital system failed to create the right amount of capital per unit of risk. Citibank had inadequate capital, even though it had higher capital. And this is a general pattern that we found during the crisis, that higher capital ratios were not associated with greater resiliency, not at all. Secondly, Citibank, when it was intervened in December 2008, had a risk-based capital ratio of 11.8%. Yes, they were in such great shape in December 2008 that they didn't need to be intervened. So it was all just a big mistake. Either that or they hadn't been recognizing their losses all along. Well, of course, it's the latter. So if you look on a market value basis of bank equity ratios, that market value of equity divided by the market value of equity plus the face value of debt, you can see that, as many people pointed out in the last session, the crisis didn't happen overnight. It happened over about 1.5 years as equity ratios fell and fell and fell and fell. And the point is, this was not secret information. This was all observable on a real-time basis. And so we allowed capital ratios to fall and fall and fall. And then when we finally got the shock of Lehman in September of 2008, that was like a match in a tinderbox, right? Why is there so much counterparty risk problem? And this gets back to the point that Mark Carey was raising about the relationship between solvency risk and liquidity risk and its complexity. But I want to point out something. Here's my claim. If the capital ratios of those banks in September 2008 had been 10% or 15%, there wouldn't have been the counterparty risks and there wouldn't have been the liquidity crisis that the Lehman crisis prompted. So the problem really was that we didn't recognize losses and require replacement of lost capital on a timely basis. That was what caused a solvency crisis or weakness in solvency to translate into a liquidity crisis. Okay, so now I've told you what the two problems are, and now I'm going to tell you how we're going to fix them. And of course, the details of this you'll have to read about because I couldn't possibly in 12 minutes go through it. What we want to do is restructure capital. Instead of just a book capital ratio, which is what we currently have, a book capital ratio on both a simple leverage ratio basis and a risk-based capital basis, we want to change it so that there, in addition to a book capital ratio, there's also a COCO requirement, a contingent capital certificate requirement, where the COCOs are going to be issued in very large quantity. So imagine about a bank would have about 10% of its risk-based assets in equity capital. That's right, we favor a higher equity requirement. And about 10% of its risk-based assets in a contingent capital certificate requirement. And those COCOs will convert if the equity ratio, that market value ratio, falls to 9%. So to be more specific, if a 90-day moving average of that ratio fell to 9%. the Cocos would be highly dilutive, not just because of their large quantity, but because they would be designed to convert at a premium to the Coco holders, so that actually the pre-existing bank stockholders would really not like this to happen. And if it did happen, probably the manager would lose his job too, the CEO. By setting this trigger very high, we expect that managers would decide to keep their market capital ratios significantly above it, let's say at 10.5% or higher. And what that means is that as they suffered losses, they would go into the market to raise more equity to make sure that they maintained a sufficiently high ratio. In fact, maybe banks would sort of start off targeting about a 12% equity ratio. We expect that these instruments would trade like senior debt, close to senior debt, because they would never be converting, almost never. Would you expect these to actually convert, because it would be so dilutive. Also, we'd expect that managers would, knowing that they would face the need to promptly replace lost capital, they might want to be concerned a lot more about risk management. Raj Cohen mentioned at the last session a study by Elul and Yeramili that I had told him about that showed that the ratio of the compensation to chief risk officers to chief executive officers was a robust predictor of the cross-sectional variation in risk during this last crisis. And the message there, of course, is not just to give risk officers more money. The message is that institutions that prioritize risk management end up effectively controlling risk. Well, we want to create strong incentives for the CEO to do that, and we think the Cocos would do that. There are lots of plans out there for Cocos. Our plan is not to create a bail-in set of Cocos. By the way, I've criticized these. Also, Charles Goodhart and Doug Diamond have criticized them. Problems are that if you set these triggers very, very low and you think of these just as a sort of buffer against loss right before you're going into a resolution, the problem is that nobody wants to buy your debt, risky debt, or equity just prior to that trigger. And so you often get this problem or a concern that you might have a death spiral. So Charles Goodhart wrote an article called "Are Cocos from Cloud Cuckoo Land?" And I want to emphasize, at the same time, Charles Goodhart finally found a Coco proposal that he likes, and he endorsed it in an op-ed that he wrote in the Financial Times this past year, and that is our proposal. So we think that we want to emphasize not all Coco plans are created equal. Ours would be credible precisely because it's set with a very high trigger, so that it's realistic to expect banks to be able to go to the market and replace that lost capital on a timely basis. Our Cocos, precisely because the risk of conversion is very low, you wouldn't be able to use the yields on these Cocos as signals of market perceptions of the risk of the firm. That is not our intent. Those are different Coco proposals. We think the essence, what is needed is to make banks have to stay with high capital. And if we have that, maybe we've gone a long way towards solving the too big to fail problem. Thank you very much.
Thanks a lot, Charlie. I would sort of say that if three-syllable words are lies, securitization is a six-syllable word, but it has three-letter acronyms like MBS, ABS, and CDO. So I definitely think it's a good rule of thumb. Our second speaker is Richard Herring, who's the Jacob Safra Professor of International Banking at our colleagues just south of here at the Wharton School, and I think we just have your
yeah, this is a technical difficulty that's my fault, and it's also a revelation of the divide between two cultures. Putting business school people together with lawyers means that you've got people who can't really talk without PowerPoints with people who talk and dislike PowerPoints. So I'm going to try to do mine quickly.
But none of whom can do social media.
Yeah, that's true. I do not tweet. I want to make that very clear from the start. Let's see, I think this is it. Yes, thank you. First of all, let me thank the organizers. This is really a spectacular array of talent. I've already learned a lot. I'm sure I'll learn still more as we go through. And I'm really pleased that people are continuing to look at the agenda for reform, because I think it's a real mistake to believe that Dodd-Frank is in any sense the last word. Obviously, I don't think resolution policy is a panacea. I fully support Charlie's idea of trying to prevent things when they happen. But bad things will happen, and it won't always be true that Cocos will prevent institutions from failing. So I think it's really very, very important that we have in place good, reliable resolution tools that can take out any institution without causing havoc in the financial system. The absence of those tools, and I would assert that we've not had them, has inevitably resulted in really frantically organized bailouts over sleepless weekends, and are not really very carefully looked through. Now, this is something that I guess Mark would contend with, but my view is that too big to fail, and by this I don't mean literally size. This is a portmanteau that means too complex, too interconnected, too central, but too big to fail has sort of caught the public attention, and so that's what I'll use. But it's simply too costly to continue. Andy Haldane at the Bank of England has made some really remarkable estimates that are pretty careful, and it shows that, and this doesn't include everything because this is of, I believe, June 2009, that the advanced countries had really bet about 25% of world GDP on sustaining their banking systems. Now, this is for a sector that accounts for less than 5% of value added. That's simply, or 6% of value added, so it's simply not a sustainable system. And you know politically what's happened. There's resentment on all sides that even though there haven't been actual transfers after the fact, and in that sense I would agree with Mark to some extent, the ex-ante risks were huge. Well, I think I'm going to skip over this because of the length of time, but if we wanted to get into it, we could talk about how you really want to measure the costs of bailouts. But I think the important thing is that the perception of bailouts is so extreme that even the New Yorker picks it up in a cartoon. This is a little boy with his sister. He's about to smash his piggyback, and he says, no, we have to just sit back and wait for the Fed to bail us out. And it's a bit extreme. I think he'll wait a long time. But if he were a little bigger and more complex, I'm not so sure. So what can be done about this kind of problem? Well, we could try to make SIFIs fail safe. And Cocos don't really attempt that, but they're in that direction. Or more often, people mean by that enhanced supervision. Or we can make SIFIs safe to fail. And it's the latter course I want to talk about. Let me first just indicate why I think heightened supervision is unlikely to succeed. And many of these points have been brought up already. There's a fundamental asymmetry. The supervisors have considerable leverage when an institution's in distress, but virtually none when it's well capitalized and profitable. I mean, what do you do as a banking? It's precisely the kind of thing that Chris talked about. Moreover, there's a tendency to withhold bad information at every single level of the process. Managers don't want to tell their supervisors. Supervisors don't want to tell their colleagues. And they certainly don't want to tell supervisors across the board. And the reason at every stage, well, the first stage is because you may lose your scope for discretion in dealing with the problem, and you may lose your job. In the other case, it's because you're afraid somebody else is going to act and remove your discretion for dealing with the problem. And many bank supervisors still have, I think, a bit of the mentality of a social worker. They're really determined to make things better. And then, of course, you have regulatory arbitrage, which is alive and well. Some of you in this room undoubtedly have jobs which touch on this. But every time there is a new, especially prescriptive regulation, and this only takes a matter of weeks, you'll have some people meeting say, these new regulations will fundamentally change the way we have to get around them. And it's a long, long story we could document any number of ways, but it is a fundamental fact of financial life. I would argue that capital regulation was a complete and comprehensive failure. Basel II was much too complicated, and the ratios were badly defined and ineptly monitored. First of all, in contrast to Basel I, which had its faults, it was enormously simple. And it was not because the people who put it together were simple-minded. Peter Cook took enormous pride in the fact that you could really write it on the back of a postcard. He didn't waste lots of compliance costs. He didn't want to micromanage banks. He wanted to just make broad distinctions. Well, Basel II went entirely in the other direction. It increased the number of categories, made much greater use of the bank's own internal models, things we thought were good at the time, and you had a real explosion in the number of risk categories. For a large, complex institution, the risk buckets increased from 7 to 200,000. To determine the regulatory capital ratio, the number of calculations rose from 7 to over 200 million. Anybody who thinks they can supervise that is delusional. What did we find out? Well, the numerator did not reflect the ability to absorb loss without going through bankruptcy. We let too much trash get into Tier 1. It had no real reflection of the institution's ability to get through a problem without going bankrupt. And the second thing we learned was that the denominator did not use realistic risk weights. And Charlie showed lots of examples of that. And of course, overall, the 8% minimum, which was never really justified, although to his credit, Mark Carey came closer than anybody I've ever seen in providing a sound ex post rationale. The regulators who invented it really did not ever explain it, except that it didn't really cause too much trouble for anybody who had to sign the agreement. And so at every bank intervention, the primary supervisor was in this really awkward position of saying, well, I don't know how this happened. My supervisee was way above capital minimums. And so there's really no reason that anybody should be worried about it. And of course, that simply shows the deficiency of capital minimums. And the next things simply show how this worked in each market. And the question is, what's wrong with these pictures? And what's wrong with these pictures is that during the worst financial crisis since the Great Depression, the ratio of risk-weighted assets to total assets was stable. And if we thought we were reflecting risk, we were just sadly deluded. Worse still, the Tier 1 capital ratios failed to warn of impending danger, and were somewhat higher, actually, for the banks that experienced a crisis than those that did not. So not only did they fail to give us the proper warning, they went in the wrong direction. This is the IMF data. So the upshot, as we learned, was that the market largely ignored regulatory capital because they didn't believe it. They didn't think it told them anything useful, and they focused on tangible equity. And so it's a mystery to me that the regulators are still trying to put forward, as the Fed is trying to do in the enhanced supervision thing, multiple definitions of capital which go a lot beyond tangible equity. Well, Basel III makes some adjustments that are good. They have more and higher quality capital. It's useful, probably not enough. And it attempts to patch some of the more obvious gaps in Basel II. It adds liquidity requirements, which I think are really not very well thought out, but it's even more complex and opaque, and it will make it even more difficult to compare banks across countries. What is astonishing to me is that in all of this experience, resolution policy was entirely ignored. And there are numerous instances in history of very close calls with the international debacle that we've just lived through that nobody paid attention to. It was almost as if this cartoon were literally true, that people thought that those who ignore history are entitled to repeat it. And I need only mention long-term capital management, BCCI, Barings. They were all really strong indications of what we could expect in 2008 and 2009, and did. So in my view, making SIFIs safe to fail is the only way to have a serious impact on what I loosely call too big to fail, but remember, I mean something much broader by it. Resolution policies got to be on an equal footing with integrated regulation and supervision. And to me, the rationale from this comes from one of Gary Stern's perceptions, which I think was very, very astute. He has, as you know, was for a long time the longest serving member of the Federal Reserve Board. And he said, then the problem, of course, is every time the regulators do a bailout, they say it's one-off and it will never happen again. And they have no credibility in that regard. So in order to be credible, I think you have to convince creditors of these strategically important financial institutions that they will be subject to a risk of loss. And that means you really have to think about why it is that regulators do bailouts. Because there's really not much you can do ex ante to prevent it except to remove the incentives for them to do so. And to me, one of the biggest problems is that they really don't have the tools in place to feel fairly confident that if they don't intervene or if they don't have the tools, that you're going to be able to remove an institution before it creates enormous disruptive spillovers. So the process to me begins with the identification of what we mean by a systemically important financial institution. Okay, I'll speed up. This is awkward because some people believe that they should not be identified ex ante, that it automatically intensifies moral hazard. Some believe that they should be identified ex ante, and some believe that they simply can't be because all of these crises are scenario specific, and so you never know who's going to be affected. I think that's sort of a counsel of despair. I think you've got to start with the assumption that, although you're not going to do a perfect job, you have a pretty good idea of who you should worry about if times get tough. And you simply counter the moral hazard implicit in that by making it very unpleasant to be a SIFI. I think fewer of them would be a very good thing. Well, how should systemically important financial institutions be identified? I would suggest it should not be by charter, and I think that's one of the fundamental problems with Dodd-Frank. And Title I and Title II are sort of silly distinctions because Title I is really all about, well, we've basically preserved the banking system and added into it bank holding companies, and we don't really know what we're doing in the shadow banking world. But the kinds of things you need to worry about are the size relative to the economy, the complexity as measured by the number of affiliates, and I'd love to make that meaningful affiliates, but as far as I know, there's no public information that allows you to do that, and as measured by the operational and financial interdependencies among the various affiliates. It's also the performance of systemically important functions. And that's something that I think both the regulators and the banks have to be very clear about because those are the things that we absolutely need to sustain in the event of a crisis. And another indication would be the number of regulatory agencies, because it's not just a country-to-country problem. It's the fact that within the United States, taking down a Citibank would require action from 3 different federal regulators, some state regulators, and all of the insurance regulators around. And even getting them in a room is hard, let alone getting them to agree on a standard way to proceed. I think you also want to worry about the degree of vulnerability to a shock. We know what those measures are. It's the amount of leverage, it's the amount of vulnerability to a liquidity shock, and I would suggest it's also the alignment between the subsidiary structure and the lines of business, which currently is just about zero. Currently, a bank's business structure has very, very little to do with its legal structures, and that's part of what makes it so difficult to resolve them. And finally, I think resolvability is actually a positive feature and should reduce the extent to which we worry about a firm because that means we can actually take it through the process very quickly. Well, the resolution and, as it was known then, recovery plan, or I guess it was contingency plan, began with the Pittsburgh Summit, the G20, which is fairly unusual. It's also known as recovery and resolution plans, wind-down plans, living wills, or more sardonically, funeral plans. It's in Dodd-Frank as resolution plans, and it should, I would suggest, try to accomplish several different objectives. Protect taxpayers, make clear to SIFIs, and most importantly, their creditors, that they are not too big to fail. Force SIFIs and their boards to anticipate and internalize some of the spillover costs that might occur, and make supervisors and resolution authorities aware of what they must be prepared to do, and take that internationally as well into crisis agencies. In my view, and here I'm going to have to go very fast, I'm afraid, it's sort of pointless to do a recovery plan. That's what banks should be doing all the time. What you need to do, and it's very contentious, what you should do is start with the assumption that the bank is bankrupt and see what you need to do to try to preserve going concern value, and dispose with the rest of it. And that requires doing a number of things, making sure you've mapped lines of business into corporate entities, identifying key interconnections, having really a virtual data room that you would have in the event of any kind of merger and acquisition, identifying key information systems, making sure they're open to everyone, and identify activities that are systemically important and systemic infrastructures to which they relate. In this day of very interlocked electronic trading and clearing, it's very important to be able to disconnect one of these entities without causing the rest of the system to fail. I think it's important that this be a central feature of corporate governance. Just as boards are supposed to look at business continuation plans, they should be focused on resolution plans, and they should ask some very tough questions about why we have such a complex system. They should examine the plans in detail, ask some very tough questions. If it's not plausible, the supervisors would then have a look at it, they would challenge it, and they should be challenging it in groups of international committees. The potential benefits, I think, are substantial. It should reduce moral hazard. It should cause SIFIs to simplify greatly their corporate structures, which are sometimes simply a matter of bad housekeeping, and to plan to preserve as much of the bankruptcy state as they can. I hope it would also induce them to reduce risk exposures, and actually would help level the playing field between SIFIs and smaller, less complex institutions. Well, I wanted to close with some key issues, which will be very, very key. Oops, stop. Well, very, very key. One key question is, will the regulators have the will to regulate? And we've been through that. Then another issue is, do we lose anything by trying to make these institutions more simple? Are there really compelling economies in scale and scope that really more than compensate for the all too apparent diseconomies of scale and scope that we saw everywhere in 2008 and 2009, with the possible exception of JP Morgan Chase? And if you hold that up as the example, I think you're kind of relying on a great man theory of institutions. Is a more ambitious international solution possible? I just want to close with the numbers Raj cited. At first, it looks impossible if you think about harmonization, because there are just too many dimensions that you have to negotiate over. But it turns out, and this is looking at the same heat map that Raj actually talked about earlier, that in fact, for each of the top 5 US SIFIs, probably the group of banks that we would all agree about having to worry about, over 90% of the total reported foreign activity is in 1 to 3 jurisdictions. And 80% of that is in the UK. So that, and this is what I find really strange, 85% of each SIFI's total reported foreign activity comes really from only 2 to 4 legal entities, which are not publicly disclosed, but could simplify the problem greatly. So,
I appreciate it very much,
okay.
Rich.
Yes. One closing thought. If we can't go that route and we rely on ring fencing, then we've got to rethink the whole structure of bank supervision. All of Basel is based on the assumption of consolidated supervision and consolidated regulation. And if, in fact, you can't move capital and liquidity from one place to another when you're in trouble, then we're building a whole foundation on something that is a delusion. Thanks. Sorry.
Thank you very much. We'll have lots of opportunities with our Q&A as well. Our third panelist, Harvey Goldschmidt, is the Dwight Professor of Law at Columbia Law School, and also has a very long and distinguished bio, as our other 2 panelists do. So you're up, and I think you're sans slides, coming from the law school tradition.
I was going to say, I'm clearly the lawyer on the panel. No PowerPoint. And it is a great contribution of the Richman Center, I should say, to bring lawyers and economists and finance types together to talk about important questions of national policy. Now, our mandate on this panel was to talk about additional reforms beyond Dodd-Frank. There is a conceptual problem in that, of course. We don't know yet what Dodd-Frank is doing. Now, we do have to think about where it's going to succeed, where it's going to create counterproductive effects, where it's going to fail, and undoubtedly some of that will be part of that immense piece of legislation. Most of Dodd-Frank right now is work in progress at best. There are dialogues among the regulators, there are some proposals out, but much of it has not become law in any sense of the term. In basic ways, it's too early to evaluate Dodd-Frank. Nevertheless, I'm going to give you 10 areas in which I think change is necessary beyond Dodd-Frank. But before I do that, let me focus on Dodd-Frank for a few minutes. I believe that Dodd-Frank has put the United States in a much better place than we were before it was enacted, but it's certainly imperfect legislation. It could have been drafted to create a stronger and more effective regulatory system and to avoid some of the uncertainty that has been created. 3 basic points about Dodd-Frank. It's new legislation. It was enacted in July 2010, of course. In its 2,300 pages, there is basically a framework established, but relatively little specificity in most of the key areas. An extraordinary amount of new regulatory authority has been granted to federal agencies, but often with only limited congressional guidance. We're quite dependent at this time on those agencies using their authority wisely. As I indicated a second ago, most of Dodd-Frank is work in progress or just a gleam in the eyes of various regulators. And that's part of what makes it complicated. For instance, in Dick Herring's very sophisticated discussion of resolution authority, Dodd-Frank does have a resolution authority provision, rapid and orderly regulation. The resolution is the language. But we don't have any idea what some combination of FSOC, the Federal Reserve, and the FDIC are really going to be able to do with that. My understanding is there are not yet formal resolution plans or living wills out there, and certainly there's never been an attempt to systematically go about the resolution of the kind of immense institutions that Dodd-Frank is aimed at. We won't know what more is needed in the resolution area until the government agencies move forward. Indeed, as we think about what the Richman Center should be doing and others like it, it's looking at key provisions of Dodd-Frank and trying to figure out how they're working and what more is needed as they really become public and come into effect. In terms of additional regulatory reforms, I've got to address for a second the atmosphere today, the get government off my back atmosphere that's developing. It affects Sarbanes-Oxley, it affects Dodd-Frank, it certainly will be addressed to any new reforms. And in reaction to this morning's panel, let me say, we've got to keep in front of us when we think about reform the cost of the scandals of the early 21st century in WorldCom and Enron, and more important, the cost of the financial crisis. We cannot ignore the indefensible greed, the tolerance of excessive risk-taking and leveraging, and the breakdowns in institutional responsibility by mortgage banks, by Wall Street broker-dealers, by rating agencies, all in the private sector, which were, for me, the primary cause of the financial crisis. In terms of government regulation, there were clearly serious failures by the Federal Reserve, by other bank regulators, and by my favorite agency, the SEC. But in general, keep in mind, the governmental failures were largely sins related to passivity and excessive trust in markets. It wasn't government failing because it was doing too much. It was government failing because it was passive. Charlie Calomiris has provided a thorough, thoughtful, and innovative proposal for contingent capital. Perhaps Cocos can provide important non-governmental incentive for proper risk management and remedial equity. But I don't have any doubt that we're going to need larger capital cushions now and in the future, and much more aggressive government oversight. I use the term perhaps Cocos can provide what's needed because you want to remember how complex the world really is. At Bear Stearns and Lehman, for instance, the senior managers had a great deal of their personal wealth and skin in the game. That didn't stop them, unfortunately, for excessive risk-taking and leveraging. We've got to be concerned on any scheme that's devised that it will have the kind of effect that we think is needed. Finally, on Dodd-Frank, if our regulatory scheme is to work, it's more than regulators with will. It's an effective enforcement system that we need. When wrongdoing occurs, you need effective deterrence and a credible threat to make people toe the right kind of mark or move towards it. There are Dodd-Frank provisions that enhance accountability and deterrence, but the current political atmosphere and the deadlocks on Capitol Hill leave me concerned about the future. As with much of Dodd-Frank, it's too early to be certain where we're heading, but strengthening our current regulatory scheme and providing adequate resources. Now, the banking agencies have much of that, but if you look at the FTC, the SEC, the CFTC, and others, we're starving those agencies in reality. They cannot possibly do the job that Dodd-Frank calls for, let alone the jobs that have been mandated for the SEC since 1933 and 34 without adequate resources, and that's not there right now. Now, turning to what remains to be done, and this may be the lawyer in me speaking again, but I believe the second most important thing beyond strengthening the agencies, and this is in no particular order, by the way, that we can do in the short run is overruling the D.C. Circuit's cost-benefit decision in the Business Roundtable case that involved proxy access in 2011. That decision should be offensive to anyone concerned about the proper role of circuit courts. Now, there's nothing wrong with cost-benefit analysis. Everybody in Washington, everyone making a rule understands the need to say, what will we gain, what will we lose? Quantifying benefit can be more difficult than cost, but that kind of thinking is correct. What's wrong is when you become hyper-technical at a circuit court. Don't defer to the agency's writing and begin to question substance using cost-benefit, perhaps, as a disguise. In many ways, what's happened is the worst situation of judicial interference in the economic sector we've had since the 1930s. And the cost of that, in terms of frozen rulemaking, hesitant rulemaking, spinning of wheels in rulemakings across the federal board, is very, very large, and for me, appalling. Second change, merge the Commodity Futures Trading Commission into the SEC. Now, I didn't learn this by way of Dodd-Frank. I've been advocating that for a long time. If we didn't have press here, I would tell you that the only reason for keeping the FTC alive is that there are two committees in Congress, one agriculture committee in both houses, that wanted to keep it. Otherwise, it is simply irrational. The CFTC is a small agency. It's never functioned particularly well. I have very high regard for Gary Gensler, but the idea of keeping the separation is foolish at this point. And the amount of wheel spinning and negotiation between the agencies going on simply is a national loss. Third, and I won't deal with this in any detail given the time, we've got to face Freddie Mac and Fannie Mae and figure out what to do. I mean, leaving those agencies hanging simply is unwise. Fourth, banking regulatory consolidation. Dodd-Frank got rid of the trivial agency, the Office of Trust Supervision. There can't be a reason to have, depending on how you count, 5 or 6 banking regulatory agencies. That consolidation ought to take place. Perhaps most often or most important is what we've been talking about. The Financial Stability Oversight Council and the resolution process are in question. We're certainly going to be studying both of those over the next group of years. The FSOC is still largely untested, has structural weaknesses. It's hampered, for example, by its composition of 10 voting members and its lack of an independent chair and staff. And it is critical that if Dodd-Frank is going to work, FSOC has got somehow to be looked at, revised if necessary, and made to work. As the first panel suggested, and I couldn't agree more, we do need global bankruptcy and resolution process negotiations. As Dick suggested, there are a limited number of states that really count in that process. There's no reason not to push forward on negotiations now. Too big to fail is my 7th issue, and again, a critical one, but we're taking it up this afternoon. Notice if we can deal with the too big to fail issue, and resolution authority is only one part of that, we avoid the need to do an awful lot of other kinds of regulation. Enhanced regulation of municipal securities was referenced this morning. That's the next potential crisis in the system. And oversight of municipal securities, getting rid of the so-called Tower Amendment, is very much needed. Okay, I'm down to only 2. We do need global information flows and systematic risk. The global aspects of this are much too critical, and of course we have a panel this afternoon. And finally, with the bias I have, we need a global language in terms of accounting and finance, and the International Financial Reporting Standards, where I'm a trustee for the foundation, would be an enormous help if the SEC would move ahead on it soon. Over 100 nations now have that system, and it would be very foolish indeed if we don't move forward. With that, I cease, Chris.
Great. Thank you very much. So I wanted to start with a question too, if the panel will open up for questions very shortly. The first is to think about, to kind of, in many of these solutions, I wanted to bring up 2 questions that I think were at least hinted at from the earlier panel and get all of your kind of brief reactions to them. The first, and this I think particularly applies to the Cocos proposal that you have, Charlie, is kind of how we think about the role of psychology or runs in sort of the financial system. One of the critiques, I think, of triggers based on sort of the market value of equity is that when people sort of lose confidence, that in itself is likely to trigger a problem. And what happens with a Cocos, in essence, is that when that happens, you get dilution. So that could then essentially reinforce the concern of a run on a financial institution because you're triggering something that just issues more equity, which is, of course, what would then kind of drive down further, potentially, the price of equity. So what that looks at. But more generally, just the issue that these things are often triggered by runs and lack of confidence, and how you address that. So.
I think that's a great question. And in our proposal, that's one of the main motivations for setting a high trigger, because the confidence about a financial institution, if it only has, let's say, a 2% market value of equity ratio, is very, very low. And it may be that that financial institution is regarded as effectively insolvent, and it may be very hard for it to raise equity at that point. And it may be precisely that's when the counterparty risk of that institution is unreliable, which is what gives rise to, you could call it a run, meaning it can't participate in the Euribor market, the LIBOR market. Its backing for its asset-backed commercial papers is not given credibility. All of the things that happened in this crisis that were liquidity run-based, asset-backed commercial paper, LIBOR, Euribor, these were really, and repo, were really all about those major counterparties. So I think having a high trigger, it's really important because it gives the bank the time and the circumstances to raise the equity. I would also emphasize that from September of 07 to September of 08, $450 billion of capital was raised by global financial institutions. The markets were open. I sat across the table in the summer of 2008 from the vice chairman of one of the large investment banks, which will remain nameless. And I said, why aren't you raising more equity? And he said, we don't like the price. He had seen what had happened with Bear Stearns. The downside was protected. Remember, Bear Stearns got $10 a share, Mark. You said that everybody got wiped out. They didn't. And that chairman knew about that downside, and he didn't like dilutive equity offerings. So he made a very rational decision. So I think we need to be clear that they could have done it. The last thing I want to say about this in response to you is, I have a book coming out I'm hoping you'll all buy, co-authored with Steve Haber, called Fragile Banks, Unlikely Partners, Why Banking is All About Politics and Always Has Been. It's coming out this year. And the point of this book is to make people have to think hard about not just the mechanics of how crises happen, but why in some places they never do. When was the last time Canada had a serious banking problem? The answer is 1839. Now, Canada has had a lot of macroeconomic shocks. It's a commodity exporting country, by the way. It has experienced bigger business cycles than the US in the exogenous sense. At its last financial crisis, 1839, no banks failed, by the way. It was just a temporary suspension of convertibility, reacting to the imported financial crisis coming from the US. How about since 1839, how many has the US had? 14. There's something going on here. It's not the mechanics of people randomly losing confidence. It has something to do with, and it's not about being in a volatile macro environment. Canada's more volatile. So we need to think about the incentives, and I know Oslo's going to talk a lot about this later, and I think that's the focal point that I want to emphasize, giving the banks the incentives to put themselves in a position where they won't be creating these liquidity crises, because it's not inevitable. We can't become Canada, but we can learn from their stability.
Chris, could I add another point about contagion? It seems to me another very big factor in contagion is when the authorities do something unexpected that causes losses. And for a considerable period in 2008, it looked as if the authorities were playing higgledy-piggledy bailout. You really couldn't tell. And it makes a huge difference as creditors try to assess the risk in dealing with their traditional counterparties. If you think the probability of being bailed out is 95%, you'll make one calculation, but if suddenly you have to revise that and think it may be as low as 5%, you're going to run immediately. And what you saw was this incredible whiplash where in Lehman you let everybody go, and then 2 or 3 days later in AIG you protected everybody. And what's the market supposed to draw from that? Not only, I think, the idea that the authorities have simply lost control and don't really have a game plan. And that's very dangerous to the system. That's why I think it's really important to have clearly defined resolution rules in place so that it's not a huge surprise when an institution goes under, and it need not be contagious. Another problem, of course, is transparency. The whole problem in 2007 was that we knew there were a huge amount of losses overhanging the system, but disclosure was so bad that we had no idea where they were settled. And for that reason, you saw all of the interbank markets simply break down.
Well, I'm thinking of myself as a rational CEO of a bank, and with Cocos. And Dick and Charlie say, I think correctly, well, there's real pressure on you to not let those Cocos be used, in effect triggered, because otherwise you're going to lose goodwill with shareholders. I mean, basically, you have to understand, Cocos, if I understand them correctly, if you two have designed them, are not to be used. Right. They're just a threat.
In equilibrium.
Yeah. The problem with that is you look at all of the CEOs who faced that. I mean, at Bear Stearns and Lehman, they were losing an enormous amount of their own personal wealth. And yet,
they would have lost their jobs under Cocos.
They were losing their job. I mean, think about everything that they had invested, and yet they moved ahead in terms of leverage, in terms of risk. So you've got to, I think Cocos can be very useful, and you've certainly got a very creative system. The Cocos that were going off on government action and other things just weren't going to work.
Yeah.
But on the other hand, you want to have some little bit of concern about how real this is all going to be.
Well, I wanted to thank our panelists very much. I had no doubt we were going to resolve the issues of the day. I think we've succeeded at that without doubt. But seriously, thanks very much to our panelists. Also, I wanted to again thank our panelists with a little bit of a gift from the school.